Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert, Stewart Heath. Now, Stewart founded Harvard Grace Corporation back in 2010, which has since expanded into Harvard Grace Capital. Now, Harvard Grace Corporation provides fractional C-level executive services to clients as well as general business consulting. Harvard Grace Capital is the real estate investment arm that specializes in various commercial asset types such as self-storage, suburban office, and industrial investments. But yet, Stewart will say to himself, he'll say from his own words that they're opportunistic investors. So they don't just strictly focus in those asset classes. They look for opportunities, and more specifically, geographic focus opportunities in Southern Tennessee and Northern Alabama. And so with that, guys, it's an honor to welcome Stewart to the show. How you doing, my friend?
Thank you very much, Kevin. We're doing great today. Appreciate you having me.
Excited to have you here. Excited to learn a little more about your business and what it is you do. So again, I'll give you that brief introduction, Stewart. I'm sure it was not all inclusive of everything that you do and that you have done. And so how about just in your own words, maybe take a few minutes, tell our listeners a little bit more about yourself, your background, and ultimately what it is you do at Harvard Grace.
Yeah, so I would say Harvard Grace Capital is sort of the culmination of my career journey thus far. I've been around a while. I'm a CPA. I thought that was going to be the greatest thing in the world when I was in college, at being a CPA, and turns out didn't like it all that much. I am still a CPA. I still love that skill set that I acquired through working in public accounting, but I really much prefer being the client rather than serving clients, if you know what I mean, and being the person that's making things happen and originating things. But somewhere along the way, through my own client base, just fell in love with real estate and its power to be able to build wealth slowly over time. And just kind of a interesting journey how I got there, but we just really focus on cash flowing opportunities, and a Harvard Grace deal should just be a cash flowing deal from day one, and I keep preaching, everybody wants to do development deals or they want the hottest stock. I just like, do you have a foundation in your portfolio of cash flowing assets? Mm-hmm. So if you want to go get crazy off of that, be my guest. But the first thing you should have in your portfolio is a foundation of cash flowing, stabilized assets. Yeah, they're boring.
Yeah, no, they are boring. But as the name alludes to, real estate investing for cash flow. We love cash flow as well, and that's the name of our game. So I can get on board with your investment thesis.
Yes.
And so in the beginning we were kind of chatting before we jumped into the show, and you made a specific point that you guys are more what's first important to you is the geographic location. So you've got a specific geographic target, southern Tennessee, northern Alabama, um, and that you're more opportunistic. So it's not necessarily asset class driven. While we all love multifamily, there's lots of other great asset classes out there. I know that you've got some self storage, you got some suburban office, you got some industrial, and maybe more than that. And so maybe speak to, um, you know, the definition for you of opportunistic. Again, we know you love cash flow, but maybe a general sense of like what a good deal is to you when you guys, something comes across your desk. What excites you, or ultimately on the alternative is what makes you throw it away in the trash can.
It's a good question, and it's a little bit more art than science, if you would. But we're looking for something that has fairly low management requirement, which is funny when you see that we do self-storage. But our self-storage is somewhat niche. Our biggest asset is a niche play of RV storage. So they're all big units. There's no mixed. There's no store. We're not selling boxes or renting trucks or anything like that. So it's absentee management to some point. We have people in an office that we manage it, and we talk to people every day. But it's a low management impact. We've converted another vacant space in a medical office building. We're rolling that out this month to office storage. Because we're right smack in the middle of a healthcare community, and they have some pretty huge and onerous storage needs for records, and there's nothing around for 3 miles. But again, that will be very low impact. We won't have to put anybody there. So what I like office generally because you don't have to be there all the time. So I say that would be the first thing that we're looking at. The next thing is, what's the cap rate? How cheap can I buy it? Because, generating cash flow from day one is all about the buy. And you probably heard people say you make your money on the buy, not the sell. And if you buy it right, you're likely going to make money ultimately. So we look at cap rate. We like service retail. Some people call that suburban office type stuff. And depending on the tenant mix, you'll look at a 7.5 all the way to 8.5, cap rate. We love medical office because the leases tend to be really long. There's not much of a threat of, from going back to the office, type of a threat, because your doctor's not going remote and he ain't coming to see you. So he's got to have an office. And so we love those kind of assets. And so generally I would say, those are the triggers we like to look at. Going back to the retail, I love retail that's got a nice mix of national and local tenants. Maybe it's got a Tractor Supply store in there with a Mexican restaurant, something like that. Just good, stabilized type of tenants and things like that.
You'd mentioned I want to unpack something real quick so I don't lose it. You'd mentioned I guess one of the niche opportunities you're working on is converting some space over to office storage, more specifically medical records. Maybe speak to that a little bit. I mean, I guess I know there's been a lot of regulatory changes over the years. I think most practices were required to move over to electronic medical records. I don't know all the nuances with the years and timelines and all that, but obviously there's still a lot of physical records floating around out there. There's some legal requirements on how long they have to be held, and so maybe speak to that a little bit. Is that a short-term opportunity play? Is there still actually a good bit of runway left on storage, niche storage opportunities such as medical records?
Yeah, the idea came to us, and it's kind of funny. I thought, no, that's stupid. And then it finally dawned on me, maybe that's not so stupid. But so in at least in northern Alabama, doctors, dentists, medical professionals, they're required to keep the physical record for 15 years after the last time they saw the patient. So they literally have boxes and boxes and boxes. That requirement might be being phased out, not locally, but we're not specifically targeting them. We're actually targeting a region of about 3 miles around this location. I built it out. I've only got 30 units. It'll be completely self-service, but we think that the biggest user will be medical in that because they have a pretty severe medical storage. Now, that might be a different requirement in other jurisdictions, but for right now in Alabama, they've got that 15-year requirement after the last time they saw the patient, and that gets into some paper. So.
Yeah, no, that's great. I appreciate that. And as
Yeah.
far as like the RV storage and all that is, you mentioned it's pretty hands off. Have you gone as far as automating any of those facilities to where it's truly just either a unique code to get in or key fob, something along those lines, where there's no physical presence at the sites?
Yeah. Yeah. Now we might be there a couple of times a week because there's always something physical that has to be done, but that's with an employee that can cover several properties. But everything else is automated. They can rent it online. They can receive their gate code online. We typically we have a place where they can pick up their keys on site. We did not digitize the locks to the individual units. As we're looking at others, that might be something, because a lot of those type devices are not as reliable as some of the gate operators, but it's as automated as we can make it at the current time. We don't accept cash. We don't accept checks. Everybody has to pay through the portal, and so there's always a few people you're chasing every month, but credit cards change, and people have issues. Out of 125 tenants, you're going to have 5 or 6 every month that have an issue. That's okay. I mean, they still have to go back and pay through the portal. They're automatically locked out of the system on the 6th of the month. So it's pretty automated, which of course affords us the opportunity to not be there all the time.
Talk to me about the target focus, geographic location wise. I mean, what's so special about Southern Tennessee, Northern Alabama that same area keeps your focus and you don't really stray from that geographic region?
Yeah, it's as simple as this is where we are,
Okay.
and as we syndicate investments to other investors, we've made a decision to. If we're selling it to the investors, we're going to manage it ourselves. We've had real poor experience over the years with third-party management companies. I don't think it's all their fault. I think that third-party management works pretty well, like in a multi-family unit or a really large office complex where you can afford to have full-time staff there. But when you've got third-party management, and they're getting 8% of the rent income, and you look at it's like that's not a lot of money. So it really doesn't. I think the model is broken, frankly. So it's really not doesn't afford them the ability to keep really high quality people, or if they do, they need 20 different properties to manage, and then it becomes unworkable. So we've chosen to manage everything directly, and our rule is we have to be able to get there within an hour. So that's why we've chosen that. We are constantly rethinking that all the time. For instance, we have a deal in our pipeline right now that's down as far as Birmingham, which is actually 2 hours for us, but it's a triple net medical office building, and we really wouldn't have to be there very often. And so is that one we could do? And the only reason that we're thinking about that is because it looks like we're going to be able to buy it for a 9.5 cap, and we'll be able to throw off some pretty serious cash flow with nice long-term leases and good runway on the leases from medical tenants. So always willing to question our rules, our criteria.
Sure.
But generally it's because we need to be there.
Yeah. Interesting. So, like you using that deal as an example, with in-place income, 9.5 cap rate, I'm assuming you're gonna, leverage a local or some type of regional bank to
Yep.
finance that deal. Where would debt be at today? 7.5 range for that, to where you at least got a 200,
Oh, the
200 basis spread.
financing.
Yeah, yeah,
Um,
correct.
I find it's really kind of all over the board, especially when you loop in the local and large credit unions into the mix. The credit unions that do commercial. I've done
Hmm.
an awful lot of financing with credit unions, and they don't live in the real world. They have their own cost of capital, and the Fed doesn't mean much to them. So, and they can either be uh, you know, really aggressive, really competitive, or they can be completely out of their minds, expensive. So it's constantly testing. There are plenty of still very hungry community banks for the smaller banks. I've never gotten much more than the time of day from most regional or larger banks. It's just not. It's just not what they do.
Hmm.
Non-owner occupied real estate. Um, but there are plenty of lenders out there.
But where are you seeing it? Like on that particular deal, I don't know
Uh,
if you've made it that far or not yet, but I mean, are you finding
I
rates up?
have not, but I expect
Okay,
the rates to be about 8,
got it,
somewhere
got it.
between 7.75 and 8.25.
Yeah,
So
okay.
yeah,
So going into it, you got at least 125, 150 basis spread in the
yes,
deal. So good,
yeah,
good deal, good deal. Yeah, which I mean, in if you were buying it at that's the thing. I think a lot of folks. I mean, I don't think a lot of sellers, that is, they haven't adjusted their pricing expectations. Like using that as the example, which 2 years ago, that same medical office building probably would have traded what for a 6.5 cap.
6.5.
Yeah.
Yeah,
So,
easy. Yeah,
um, and then a lot of sellers haven't adjusted their expectations, right? And so maybe they adjust them slightly, and so they're like, okay, this is a great deal. We're selling at a 7.5 cap. Well, that's not a great deal. That's negative leverage, and like the leases are fixed in place for quite some time. While there might be some upside on lease renewals, I mean, there's absolutely zero cash flow today, and I think
yes,
that's more common than not. Very rarely are you seeing actually 9.5 cap deals that are
yeah,
good markets, good assets, and good locations
yeah,
come to the market, right?
yeah.
Unless
I've
the
actually,
unless the underwriting is a little skewed, right? That where it's being presented as a 9.5 cap, and you get in, you realize that it's actually it's an 8 cap.
yeah, yeah, exactly. Yeah, I've really questioned, the seller on that particular, but it's like, sure, this is the price, and the broker really, it's like, is there a problem with the building? Is the seller got some sort of desperation? And apparently, no, that's just the price he sort of decided on. We've not gotten in and be able to do our due diligence, hadn't been able to do the inspection yet, but the leases are high quality. And so there's a lot left to be learned before because it does look too good to be true, but but that's why you keep on going. Um, but the name of the game is you keep looking at deals, because every now and then one of them stands out as a great deal. So so if we're able to pick that one up and it is what it appears to be, that's a slam dunk. So
Yeah. So talk to me about finding deals. I mean, what's the secret sauce at Harvard Grace? I mean, how do you guys source the majority of your opportunities? So is it broker based? Do you guys do any direct to owner type marketing? What's the best source that you found?
it is mainly broker base, as well as a disciplined search of Crexy and CoStar all the time. And it has been our intent, it's been our goal to start some direct to owner work this year, but we just haven't gotten to that yet. Uh, I will say this: um, I've written more offers this year than I wrote all of last year.
Hmm.
For starters, there was not much quality for sale last year, and but something with the change of the new year, and there was an awful lot of really quality stuff that's hit the market at much more reasonable prices. So even last fall, somebody was still trying to get a 6.5 on a 6.5 cap on a on a mediocre retail property, that same property, would probably be listed for an 8 cap this year.
Mm-hmm.
So something's happened in the mindset change. I don't know if the sellers just sort of came to reality. And if you didn't need to sell last year, you shouldn't sell.
That's
Uh,
right.
you, and you shouldn't sell now unless you really need to. But we're all looking for the opportunities these days because we think it's coming. So
I think you make an important point there, and about if you sold last year, I mean, if you didn't need to sell, you shouldn't have sold last year, and also this year, if you don't need to sell, if you're not pressured to sell for XYZ reasons, then it's probably also not the best time to sell. And so my perspective is that if like last year, for example, our company had the biggest year ever as far as acquisitions. However, we were super conservative years prior. We weren't nearly as active or aggressive into buying than a lot of our competitors were. And so that really put us in a, and I'm not going to say I knew exactly that's how it was going to play out, right? But it put us in a really strong financial position last year to we didn't buy a lot, but we had the biggest year ever. And we bought some assets that not distressed assets, but distressed owners. Either
yes, yes,
their equity partners were forcing a sale, a debt maturity was one of them. Just situation, and a lot of our competitors were on the sidelines because their liquidity dried up. Maybe they were dealing with their own damage control, like within their portfolio, because maybe they overpaid or just for whatever reason. We just had a phenomenal year, and so like it's been good to see um some more activity. In fact, to your point, this year is actually starting out on a great foot for us as well, again with a lot of the competitors that we would have had years past. Just they're not really competitors at this point for XYZ reasons. So
right,
I'm excited about the opportunities. And I don't think it's necessarily going to be it's not going to be distressed assets more than distressed owners.
yes,
It's very different than that of what 2008 might have looked like. So
yeah,
I think there's a lot of opportunity out there. And again, I just if you guys are out there looking for deals, just know, like, as you look for things, if they truly are for sale. Now, don't get me wrong, there's still those seller tire kickers that just they haven't come to reality yet, right? They're just going to throw it out at some ridiculous price just to see if there's any crazies out there like there were 3 years ago, right? But for the most part, someone actually truly goes through the entire listing process, goes through the broker opinion of value, the whole marketing, rigmarole that exists, and they put that out in the mass marketplace. Even if it's overly priced or overpriced, know that there's probably still a reason why they actually put it up for sale. Like it's most folks don't simply just go through an exercise of brain damage of listing their property just for the fun of it, right? And so
right,
I think it's still worth it. What we've been doing is we've still even deals that we feel right out of the gate are overpriced. I mean, if we do our quick back of the napkin, spend 10-15 minutes on it, we're like, man, this thing, like, there's such a big delta between where we're at to where they're asking. We still make an offer, put some true reasoning behind it. We'll go as far as sending a video to the broker of, like, here's our underwriting. Like, we'll take a deep dive. Like, here's our underwriting. There's a pretty big delta here. I'm not sure exactly where your assumptions came from, but we know this market well. Familiar with this asset. This is how we feel it's going to actually play out. Here's our offer. Even if it seems like it's going to be an offensive offer, we've found that we actually have gotten a lot of traction. We just got a LOI. We got a count on an LOI the other day. They were asking seven target price was 17 to 18 million dollars, and we were working very hard to get to like 12.3 million dollars, working very hard. And sure enough, we literally just got a counter yesterday that came back at 14 million. So I mean, almost immediately $3 to $4 million off of where they were
right.
targeting, right? And it tells me if we were at the low 12s and they counted at 14, most other offers probably came either close to ours or below ours. And we kind of rose to the top fairly quickly of probably the most qualified buyer. So I don't know if we're going to get that deal, but I can tell you that just for the fact that we went through and spent time explaining our offer, not just throwing it out there, because most of the time that would have been perceived as an offensive offer. 12 million and they're
Yeah,
asking 17 or 18 million, right? That's a pretty significant discount. But it
completely
got
agree with you.
activity, it got traction. And anyway, just sharing that with those that are listening.
Yeah,
Again, if someone's putting something, I don't know the story behind why they're selling these two assets, but my guess is that there's a little bit of motivation. They're nice assets. They're not distressed, but there's probably
right.
motivation on the partnership level more than anything else, or maybe it's some debt debt pressure, maybe loans coming due, things of that nature. So anyway, just want
I
to share
have,
that.
yeah, I bought a lot of property doing exactly what you did. And we always send our own valuation analysis when we send our first offer. And most
Mhm.
deals that we've done, we've got an average of 10 to 12 months from first contact to close. So, and we're rarely ever the seller's first choice.
Yeah.
But we do what you do. And long time ago, there was this guy who used to have infomercials on TV called Carlton Sheets about how to buy real estate, no money down. He was very early in that. So, and I had his course. I bought it in year 2000 or something like that. And the first thing he tells you in negotiating, I've used this many times, if you're not offended by your first offer, then you're offering too much. So I've used that. I'm sorry, not offended. If you're not embarrassed at
That's
your
right.
first
Yeah.
offer, yeah. I said, yeah, that makes sense. But I've always got a mathematical reason behind it. So yeah, we're coming into an age where there's true negotiation that's going to go on again, rather than it was just buy.
I think
So
also you gotta understand, forget what the market's doing, forget what other buyers are offering. I mean, what are your objectives for that investment?
absolutely,
What financial targets do you need to hit for however if you're doing a syndication, however that might be structured with your limited partners, right? Like, um, anyway, like we don't that's the most important. If you know all those and you have clarity as to what the thing actually what the asset needs, how it needs to perform, then you should be skilled enough to be able to actually figure out what number you need to buy it at in
right,
order for that to occur.
yeah,
And that's it. Like there's no
yeah,
either you buy it at that number or less, but you
yeah,
don't buy it at more than that number. Otherwise,
right.
you're going against your own principles, which you probably
There,
didn't
there's
have
always
if you
there's
actually
always
offered more.
stupid capital. Yeah, there's always stupid capital in the market. There's always somebody who just did a 1031 and needs a replacement property and will overpay because they don't want to pay taxes. I mean, there's always a few people, or maybe there's a REIT or somebody that has to put some money to work before the end of the quarter. There's always these people that have some motivation to do less than what we would consider the correct deal. And you can't compete with those guys. So
Right.
all you can do is do what's right for you and your investors. So yeah.
That's right. That's right. So talk to me about any changes you guys have made to your business at all. Maybe you haven't, but obviously the last year and a half has brought about quite a bit of changes, generally speaking. Just curious as to have you guys made any pivotal changes on either on operations or acquisitions, any part of your business, given some of the market shifts?
Yeah, we are pretty committed to our principles. However, our principles actually deliver us, a narrow field of opportunities. So we're actually internally discussing, because we want to do more deals. All right, we're not going to do development. We're not necessarily going to do value add, that involves construction or things like that. But we're now looking at deals that so they may not cash flow from day one, but we know exactly how to fix it through management.
Mm-hmm.
Because there's a lot of properties that are underperforming just because they're mismanaged. And so that would be our own value add. And that's not something that we've um, pursued before because we want everything to cash flow from day one. But if you can get it to cash flow in 9 or 12 months or something, and yeah, so that's a little bit different. And huge upsides in there. You can usually buy those pretty well um, because they've done their own NOI and their own mismanagement makes their NOI lower than it should be. So that's really where we are. We're fairly conservative. Um, uh, we're pretty far off from ever really considering a development deal. The next thing we would like to do would be expand our geographic area if we've
Mm-hmm.
got good partners in that area. So we like our model. It's working. It's our investors are happy. And so we're just going to be a little bit more opportunistic on things that do not have the risks of development and construction to them, but where it's just a management issue, because we do know how to manage. So
Yeah. So I'm looking at a map here just for our listeners. I wanted to share a better understanding of your geographic focus. That way, if anyone's listening, they've got some opportunities in those respective markets, they can reach out to you. So I know it's the north south I-65 corridor. That's one of the markers. I think you said basically south of Nashville to north of Huntsville. The in between there, and then what's east to west? What's the parameters? Or do
we'll
you,
go as far as I-24 on the east side, and not right now, not very far west, on the west side of I-65. We might take in Pulaski, or we are looking at deals in Athens and Decatur, Alabama. Um,
Is that
because
mostly because it gets too rural once you head to the west of 65?
yes, yeah.
Okay. Yeah.
Um,
We've
it,
owned that. We've owned assets. We've owned mobile home
yeah,
parks in Athens, Alabama. It's been
yeah.
a few years, but it's
Athens
great.
is
It's a great. It's a great market. It was a great
one of the
market for
fastest
us.
growing. Yeah, Athens is one of the fastest growing cities in Alabama right now. So,
Yep.
And it's all coming out of this Huntsville military defense engine that's also
Mm-hmm.
been matched in the last few years with industrial expansion. Toyota and Mazda's got a new plant there, and it's just a juggernaut that looks like it's going to go for many more years. Huntsville's already the largest city in Alabama, and Madison County, where it is, will likely be the largest, most populous county in another 5 years, even larger than Jefferson County, Birmingham. So it's a very high income, highly educated
Mm-hmm.
community there. So it's really kind of a nice place to be.
So, Stuart, for those that want to learn more about you and maybe reach out to you, figure out what type of investment offers you might have, where's the best place to track you down?
The best place, and we are on all the social media channels, but the best and easiest place is harvardgrace.com. We have resources there that are free for people, how to evaluate an investment sponsor, reasons that you need to be investing passively in real estate. That's the best place. You can find a Calendly link there if you want to book some time with me. Always happy to talk real estate with anybody, almost anytime. So thanks for the opportunity, Kevin.
No, thanks for joining me here, Stuart. It's been a pleasure having you. I learned a lot during the time together, and best of wishes in 2024 as we continue to be opportunistic and find some great deals. So, wishing you the
Same
best.
to you, my friend. Thank you.
Alrighty, guys, that's all we have for this week's show. So, until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.